Hello and welcome to AI Market News by LM. Before we jump into dissecting the global markets, we need to provide a mandatory disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. Crucially, this content does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, let's unpack this stack of sources then. Our mission today is really to cut through the noise. We want to deliver a concise, structured understanding of the current global market. We'll be focusing on, well, the powerful momentum driving U.S. equities right now, the sharp divergence we're seeing in key currency pairs, and also the macroeconomic catalysts that are, dictating investor risk appetite this week.
Yeah, and what's fascinating here is that the market is kind of grappling with this core tension. I mean, on one hand, we just witnessed the U.S. equity market achieve its best two-day rally since June. That effectively erased the concerns that those geopolitical fears had caused. That's a massive burst of risk-on behavior. But the fundamental question we really need to ask ourselves is this rally built on concrete earnings and economic stability? Or is it just pure relief and maybe hope fueled by political de-escalation?
That tension is definitely palpable. If we look at the immediate snapshot, the index futures this morning, they're telling a tale of pause, right? After such a dramatic run, U.S. futures are indicating a flat or maybe marginally soft start. They're giving back only a negligible fraction of those recent gains. The S&P 500 futures are essentially flat, maybe down 0.04% in recent quotes.
Yep, basically flat.
And the NASDAQ 100 futures are showing only a modest dip, around minus 1%. Feels like consolidation, not really a retreat.
Exactly. And if we connect this to the bigger picture, the sustainability of this rally is, well, it's definitely debatable. The prepared sources highlight that the Magnificent Seven stocks, the mega-cap tech giants, they accounted for approximately 50% of the entire equity market gains in the past session.
Half the gains.
Yeah, that concentration is it's a double-edged sword,
It really makes us wonder how stable the foundation truly is if half the building is resting on just 7 pillars. We saw a great example of this concentration with Apple, right? It surged nearly 4% on fresh optimism surrounding iPhone demand.
Huge move for Apple.
But we can't ignore the breadth of the bounce either. I mean, regional bank stocks like Zion and Western Alliance, they showed a really strong recovery, erasing the losses from the prior week.
That's a good point. It does suggest the confidence might be broadening out a little, even if the main driver is still narrow.
So where does that leave market sentiment?
Well, this immediately raises the issue of sentiment. When we look at the Fear and Greed Index, which is a composite of 7 different indicators, we are seeing a rapid shift away from that acute fear we saw maybe a week or two ago. And here's where it gets really interesting. The VIX, Wall Street's fear gauge, it has dropped an incredible 10 points in just the last 2 days.
10 points.
Yeah. That plunge isn't just a sign of calm. It signals that large institutional players are rapidly unwinding their geopolitical hedges. They are actively reducing their market protection. It drastically changes the underlying risk appetite across the board.
So volatility is just exiting the room and money is being deployed.
Yeah.
That shift from, let's say, high stakes hedging to capital deployment, that leads us directly into the fixed income market, doesn't it? How is this reduced fear showing up in treasury yields?
Right. The moment volatility backs off, fixed income investors start breathing easier, and that reduction in fear is immediately visible in treasury yields. We are tracking a clear rally in U.S. treasuries, which pushes bond prices up and yields down. Crucially, the 10-year yield is now holding below that key 4% psychological threshold, currently around, 3.986%?
Below 4%.
Yeah, which suggests reduced systemic nervousness. We also see the 5-year at 3.578%, and the 30-year at 4.576%.
And when we look at the drivers for interest rate traders, the market's main compass right now is still the Fed, I assume.
Oh, absolutely. The data we have from sources like the CME FedWatch tool show that the probabilities of future FOMC rate moves remain the primary focus. Those probabilities are constantly adjusting the assumptions beneath the bond market. It's what everyone's watching.
Okay, so bonds are rallying, yields are down. Let's move to FX. How are the major currency pairs reacting?
Well, the major currency pairs are displaying some contrasting dynamics. It kind of reinforces the divergence between U.S. monetary expectations and the rest of the G10. The euro-dollar pair, EUR/USD, it's slightly soft. Last quoted around 1.1622, down about 1.17%.
Okay, slight softness there.
But the real story, which I think has significant structural implications, is the yen, We observe continued, maybe even accelerating weakness in the USD-JPY pair. It's trading firmly above 151, near 151.84 actually, up almost 0.75%.
Above 151, wow. And that's tied to the Bank of Japan.
Yeah, strongly linked to the BOJ's expected path. Based on recent commentary, they are reportedly not in a hurry to raise interest rates or normalize policy rapidly. That fundamental reluctance just keeps the pressure firmly on the yen, almost regardless of where U.S. rates move in the short term.
Okay, so equities are rallying, VIX is down, bond yields are lower, dollar-yen is screaming higher. Feels pretty risk-on.
Right, but here's the major contradiction we need to flag. Despite the calming VIX and the sharp bounce back in risk assets like stocks and even those regional banks, our sources point to a massive move lower in the, let's say, highly speculative crypto market. Bitcoin plunged below $109,000. Wait, let me check that number. One source says $108,221. It lost well over 3%. Some commentary even mentions 11.5% down, a big drop.
Whoa, okay, so Bitcoin is tanking while stocks are rallying. That's quite a divergence.
Exactly.
So are we seeing institutional optimism being built on maybe shaky geopolitical truce ground? While the, let's call it the true risk-off money, the crypto speculators, are signaling genuine panic.
Well, that Bitcoin drop is definitely being viewed by some analysts as a potential harbinger, a sign of a broader, maybe deep-seated risk-off sentiment lurking beneath the surface.
It's a classic divergence, isn't it? Between regulated assets pushing higher on earnings and hope, and speculative assets flashing red.
It really is. And that divergence makes the global catalysts that much more important to watch. I mean, much of the recent enthusiasm driving stocks stems from shifting geopolitical rhetoric, especially concerning U.S.-China trade. President Trump is striking a decidedly optimistic tone. He's expecting to work out a fair and great trade deal with China soon.
Which is obviously a massive relief, especially for industrial and cyclical stocks.
Absolutely. But the optimism is time-bound, and that's the potential danger here. The sources are careful to remind us that the current trade truce is set to expire on November 10th.
Not far away.
No. And the threat of 100% tariffs remains an active lever should those ongoing talks ultimately fail. We really need to watch that date closely.
Okay, noted. November 10th. Meanwhile, let's look east. Beyond just monetary policy in Japan, the naming of Takaichi as Japan's first female prime minister. That seems like a significant political shift. Does it have market implications?
Oh, absolutely. It has profound market implications that go beyond just simple headlines. It's more than just a momentary political blip.
How so? What's the market angle?
Well, her expected pursuit of genuinely pro-stimulus policies focusing heavily on defense, cybersecurity, and infrastructure spending. It suggests a lasting structural change in Japan's economic approach compared to previous regimes, potentially. This expectation is fueling rallies in Japanese stocks. The Nikkei is approaching that key 50,000 level.
Wow, 50,000.
And concurrently, it's contributing to the weakness in the yen we just discussed because, well, stimulus generally means more money printing, relatively speaking.
Right. That combination of political intention and monetary policy certainly makes Japan a crucial market to watch. Now, shifting gears a bit to strategic economics, the U.S. and Australia just signed a critical minerals agreement. That sounds important.
It is. It's aimed explicitly at addressing supply chain vulnerabilities. This is a long-term strategic chess move. It involves an initial investment of over $1 billion and commits to an $8.5 billion project pipeline down the road.
And
the intent is explicit, countering China's tight grip on rare earth supply chains. These are essential components for everything from next-gen smartphones to advanced defense systems. It's a direct response to global trade friction and really a push for supply chain autonomy among allies.
Okay, makes sense. And finally, we can't overlook the ongoing earnings season, which you mentioned is providing some fundamental bedrock for this equity rally.
Exactly. What's fundamentally supporting this upward trend, maybe more than people expected, is surprisingly strong corporate performance. We're seeing roughly 85% of S&P 500 companies reporting so far beat their profit estimates.
85% beating estimates. That's pretty strong.
It is. It provides a genuine non-geopolitical foundation for the current upward momentum.
All right, so that brings us to looking ahead. What key events should we be tracking for the rest of the week?
Okay, let's outline the key events. Tracking the economic schedule, we can use investing.com or other major financial news providers, shows several critical moments.
Okay, what's on tap for today, U.S. Eastern Time?
Today, traders should monitor the NY Fed Treasury purchases at 10:30 a.m. ET, which can influence liquidity. And then later this afternoon, the API crude oil stock change data at 4:30 p.m. ET. That directly impacts energy pricing, of course.
Right. And earnings are still rolling in.
Oh, yeah. Big ones today. We're watching General Motors before the bell. And then after the close, huge reports are expected from Netflix and Texas Instruments.
Okay, Netflix and TI. Those tech and consumer discretionary names will definitely be key in validating that Magnificent Seven momentum, or maybe challenging it.
Precisely. Meanwhile, over in Europe, we should continue to focus on the European Central Bank. Speeches from ECB President Christine Lagarde and other officials could easily inject fresh volatility into the euro, especially given the current softness we noted in the euro-USD pair.
Got it. But the big one. The main event is later this week, right?
That's right. The biggest piece of macro data everyone is truly awaiting comes later this week. The crucial US CPI data, inflation.
The inflation number, yeah, that's always key.
Absolutely. That report is expected to provide much-needed clarity on inflation dynamics. If inflation surprises high, well, it instantly shifts those Fed watch probabilities we talked about, and it puts renewed pressure back on Treasury yields, potential halting this recent rally in its tracks.
Okay, so let's try to summarize the current picture then. We have strong underlying equity momentum, driven by better-than-expected earnings and that dramatic reduction in geopolitical tension, which has calmed the VIX right down.
Yeah, much calmer surface for sure.
But this strength is contrasted by, well, softness in the futures this morning, and that loud, clear risk-off signal coming from the speculative crypto market.
It's a market built on hope, maybe, but underpinned by somewhat better fundamentals than many expected just a few weeks ago.
So the key question for us now, maybe, is whether the optimism generated by political de-escalation and these strategic pacts like the minerals deal, can they genuinely shift the balance of power in critical supply chains over the next 12 months? Or is the impending November 10th tariff deadline just too big a hurdle, meaning this entire rally is just a short-lived pause before the next wave of volatility hits? Something to think about. Thanks for watching. Don't forget to like and subscribe.